The first thing you need to know about the stock market is there's two ways to invest. There is analytical investing and there is fundamental investing. They're two totally different things. Don't mix up strategies with one or the other because they can spell disaster for you. Fundamental trade is like Warren Buffett, JP Morgan, old school trading where you research a company, you dig down through their quarterly reports. You know everything about them, you know what they're selling, you know what their products are, you know what their bottom line is, you know what their income is, you know what their competitors are, and you know all the information about the competitors too. That's the old school way of investing, and it still works and it's still very important. I recommend whether you want to be a day trader or a long-term trader that you learn the fundamentals of trading. Some things that you should Google and learn: income statements, balance sheets, and cash flow statements. Also 10Qs and 10Ks. All of those things are very, very important for fundamental. Now, analytical investing is a more modern approach of investing, and that's the one that you're probably most familiar with, where some guy sitting in front of like 20 screens with all kinds of data running through it. That's analytical investing. And it's not nearly as complicated as it seems. Now, the way analytical trading goes is there's a few different types. The two main ones that you'll see is day trading and swing trading. They're essentially the same as far as principles and philosophy, but day trading is what it sounds like. You buy a stock and you sell a stock in the same days, usually within minutes. It's very quick trading and you can make a lot of money if you can do it effectively. Swing trading is where you buy a stock and you sell it the next day or a few days later or a week. It's very short-term trading. But before we get into any more of that, I need to explain to you how the stock market works and what makes it go. Now, if you've ever looked at a stock market chart, it's probably looked something like this. Now, what analytical traders do is they try to figure out if the stock's going up or down. And if you can do that, you can make a lot of money. And the way they do that is looking for what's called supports and resistance lines. The stock market moves up and down no matter what. It rarely ever stays straight. And these oscillations can be predicted if you know what to look for. It's just looking for patterns. That's all it really is. The most fundamental way they do it is they look at the peaks and the valleys, and by doing so, they can predict where the stock market is going to be in the future. The simplest way is just going off the last two peaks of what they have. So if this is the top line, this would be considered the line of resistance, and this would be called the support line. Now, what day traders and swing traders do is they watch the stock and they graph out where these lines are. And there's a lot of different ways to do this. This is the most simplest way. In the next video, I'm going to show you all the different kinds of ways you can do it and my particular setup that I'll be using to test out. So what these guys do is they watch the stock, and as it's moving up and down, if it crosses the resistance line or the support line, it's called a breakout. This right here is where it would be considered a breakout. Now, day traders and swing traders buy stock right here at this point, and they will ride the line up and recalculate where the new resistance and support lines are, and that's how they make their money. That's the basics of analytical trading.